Over 100 million Americans have no life insurance at all, and half of those who do have a policy have so little coverage, their family could not survive without them. Life insurance is one of those things everyone knows they need, but almost nobody actually understands. Agents use jargon to confuse you. Companies design products to maximize their profits, not your protection. So let's strip away the complexity and start from the bottom. There are two fundamental categories of life insurance: term life and permanent life. Everything else, whole life, universal life, variable universal life, indexed universal life, those are all just variations of permanent life insurance. Get this distinction wrong, and you might spend years paying thousands of dollars into a policy that gives your family less protection than a simple term plan would have. So let's start with the product that actually makes sense for most people. Term life insurance is simple. You pay a monthly premium. If you die within the term, usually 10, 20, or 30 years, your beneficiaries receive a tax-free death benefit. If you outlive the term, the coverage ends and you paid nothing for nothing. That might sound like a waste, but here's the key insight. Term life is cheap. A healthy 30-year-old can get a $500,000 20-year term policy for around $25 a month. That's the price of a streaming subscription to protect your family from financial ruin. Now, permanent life insurance, whole life, universal life, and their cousins, covers you for your entire lifetime. It also builds what's called a cash value, a savings component that grows tax-deferred inside the policy. This is where most insurance agents earn their commission and where most consumers get tripped up. The sales pitch goes like this: why rent your insurance when you can own it? With whole life, you're building equity. But here's what the pitch leaves out. A whole life policy with the same $500,000 death benefit as that $25 term plan might cost $400 a month or more. And the investment portion of whole life typically grows at just 2 to 3% annually, far below what a simple stock index fund would return. So how do you know how much coverage you actually need? This is where most people go wrong. They either guess or they take the agent's word for it. Here's a framework financial planners call the DIME formula: debt, income, mortgage, education. First, add up all your outstanding debt: car loans, credit cards, student loans, everything except the mortgage. Second, multiply your annual income by 10. This funds your family's living expenses during the years they need your income most. Third, add your remaining mortgage balance. Nobody wants their family to lose the house. And fourth, estimate future education costs for your children. Add it all up, and you have your coverage target. For a 40-year-old earning $75,000 per year with a $250,000 mortgage, 2 kids, and $20,000 in car debt, the DIME formula puts you around $1.4 million in coverage. That sounds enormous, but a healthy individual can get a 20-year term policy at that level for around $60 to $80 a month. That's 2 takeout dinners per month to ensure your family's financial future. One thing most people miss: your insurance needs change as you age. In your 30s, your risk exposure is highest: mortgage, young children, student debt. By your mid-50s, those debts are paid, the kids are grown, and retirement savings have accumulated. Your coverage needs shrink dramatically. This is why many financial advisors recommend laddering policies, buying multiple smaller term policies with different expiration dates, so coverage scales down as your obligations decrease. Here's something most agents forget to mention when you're signing. Riders. Riders are policy add-ons that customize your coverage, and some of them can be genuinely life-changing. The Accelerated Death Benefit Rider allows you to access a portion of your death benefit while you're still alive, if you're diagnosed with a terminal illness. This can be the difference between affording end-of-life care or not. The Waiver of Premium Rider is exactly what it sounds like. If you become disabled and can't work, the insurance company waives your monthly premium, keeping your policy in force exactly when you need it most. Then there's the Return of Premium Rider. At the end of your term, if you're still alive, the insurance company refunds every premium you paid. It's essentially a savings mechanism built into the policy. The catch: it can double or triple your monthly cost. For most people, the math doesn't work in their favor. You'd be better off investing the premium difference. But for those who are psychologically uncomfortable paying for insurance they might never use, it provides real peace of mind. Finally, the Critical Illness Rider pays out a lump sum if you're diagnosed with covered conditions like cancer, heart attack, or stroke, while you're still alive, to use that money for treatment, recovery, or any other need. So, what should you actually do? Here's a clear framework. If you have anyone depending on your income, a spouse, children, aging parents, a business partner, you need life insurance. The only question is which type and how much. For most middle-class families, buy term. Sufficient coverage based on the DIME formula, for a term that covers your peak financial risk years. Then, before you sign anything, compare quotes from at least 3 different companies. Insurance premiums vary by more than you'd expect for identical coverage. An independent insurance broker, not a captive agent tied to one company, can shop the entire market for you. Get your medical exam done proactively and honestly. Healthier means cheaper, every time. If you currently smoke, the premium penalty is severe. In many cases, 2 to 3 times higher than a non-smoker's rate for identical coverage. If you quit smoking for 12 months before applying, many companies will reclassify you as a non-smoker. That decision alone can save you 40% or more on your monthly premium. And revisit your coverage every 5 years. Life changes. Life insurance isn't exciting. Nobody wants to sit down and think about their own mortality. But the consequences of getting it wrong or ignoring it entirely are catastrophic for the people you love most. The formula is straightforward. Term life insurance, sufficient coverage calculated by the DIME formula, the right riders for your situation, and a broker who works for you rather than the insurance company. If this video helped clarify something you've been putting off, here's what to do next. Run your DIME number, get at least 3 quotes from an independent broker, and lock in your coverage while you're healthy. Because the best time to buy life insurance is always before you need it. Subscribe for more financial education explained clearly, without the jargon.